68 basis points. Pause. That's the difference between two ETFs that hold almost identical stocks in almost identical proportions. One charges you $7 per year for every 1,000 invested. The other charges you 70. And over a 20-year investment horizon, that gap could cost you over $40,000 on a $100,000 portfolio. But here's what's going to bother you. The expensive one isn't always the wrong choice. Today, I'm breaking down VWO versus EEM, the two titans of emerging markets investing. By the end of this video, you'll know exactly which one belongs in your portfolio and why the obvious answer might be dead wrong. Let's start with what you're actually buying. Pause. VWO, Vanguard's Emerging Markets Fund, tracks the FTSE Emerging Markets All Cap China Inclusion Index EEM. BlackRock's iShares version tracks the MSCI Emerging Markets Index, different indexes, different methodologies. And this matters more than most investors realize. VWO holds over 5,000 stocks. EEM holds around 1,200. VWO includes small caps. EEM doesn't. VWO has significant exposure to China A shares. Those are mainland Chinese stocks that foreign investors couldn't even access until recently. EEM's China exposure is primarily through Hong Kong listed companies. So right off the bat, you're not comparing apples to apples. You're comparing apples to slightly different apples with a completely different price tag. Now let's talk fees, because this is where it gets interesting. Pause. VWO charges an expense ratio of 0.08%. EEM charges 0.70%. That's nearly 9 times more expensive. For a $50,000 investment, you're paying $40 a year with VWO versus $350 with EEM. Over 10 years, assuming 7% annual returns, that fee difference alone costs you over $4,000. Over 30 years, we're talking about real money, potentially tens of thousands of dollars evaporating into fund management fees. But stop right there. Pause. If fees were everything, this video would be 30 seconds long. Buy VWO. Don't buy EEM. Go home. But the market doesn't work that way. Here's what nobody talks about: tracking, error, and liquidity premium. EEM has been around since 2003. VWO launched in 2005. EEM has massive institutional adoption. We're talking about average daily trading volume that dwarfs VWO by a factor of 4 to 5 on most days. That liquidity matters. When you're moving serious money, bid-ask spreads can eat into your returns faster than expense ratios. For a retail investor putting in $500 a month, probably irrelevant. For someone managing a 7-figure portfolio or trading options on these ETFs, EEM's liquidity is worth something. The question is whether it's worth 62 basis points. Pause. For most of you watching, it's not. Now here's the performance reality check you've been waiting for. Over the past 10 years, VWO has returned approximately 2.8% annualized. EEM has returned approximately 2.2% annualized. Pause. Let that sink in. The cheaper fund outperformed by roughly 60 basis points per year. Almost exactly the fee difference. The market did the math for us, but zoom out further. Look at different time periods. There are stretches where EEM outperformed. There are stretches where VWO crushed it. The fundamental truth is this: these funds are more similar than they are different. They rise and fall with emerging market sentiment. They both got hammered in 2022. They both benefit when the dollar weakens. The fee is the most predictable variable in the entire equation. Let's talk about the hidden cost nobody mentions. Pause. Tax efficiency. VWO has historically been more tax efficient than EEM due to Vanguard's unique ETF structure and lower turnover. This doesn't show up in expense ratios. It doesn't show up in most comparison tools, but in a taxable account, it compounds year after year. This is the silent wealth killer that separates sophisticated investors from everyone else. So what's the verdict? Pause. For 95% of investors watching this video, VWO is the better choice. Lower fees, broader diversification, better tax efficiency, solid tracking. If you're buying and holding emerging markets exposure for the long haul in any account type, VWO wins. EEM makes sense in exactly 3 scenarios. 1. You're trading options and need the liquidity. 2. Your 401k only offers EEM as the emerging markets option. 3. You specifically want MSCI index exposure for correlation purposes with other investments. That's it. Those are the edge cases. Everyone else is paying a premium for a brand name. Here's your action step. Open your brokerage account. Check your emerging markets holdings. If you're sitting in EEM with no strategic reason, consider the tax implications of switching. If you're starting fresh, you now know exactly which direction to go. Pause. If this breakdown saved you from making a costly mistake, hit subscribe. I release data-driven analysis like this every week. No fluff, no hype, just the numbers that actually matter for building wealth. Subscribe now and I'll see you in the next one.